Hi, my name is Jeff Luke. I started investing when I was 27 years old, and I'd like to thank you for watching my video. Now, I've learned along the way a pretty simple plan that helps people to develop financial freedom just by building a really solid foundation, and you can do this by learning how to invest in the stocks of American companies. Now, I think a lot of people really want to begin investing, but they are very fearful and kind of apprehensive, so they never do it. And my thinking on this is that it's because they don't know enough. And so I really help people to overcome a lot of that fear of starting to invest just by teaching some of the really solid fundamentals of investing. And that is why today I want to teach you about this book, The Intelligent Investor by Benjamin Graham. Now, I first got this book and started reading it when I was pretty young. And there's a lot in that book, and first of all, I want to really recommend it highly. Even if you're just starting out, I think there's a lot in there that can be useful. It's in a little bit more formal terms. That would be a great book. I would say anyone from about 18 years old or older should be able to understand it. And just a little bit about the author, Ben Graham. Ben Graham was a professor at Columbia University in New York. And when the investor Warren Buffett was really young, he read this book in the library, The Intelligent Investor. He read it in the Omaha Public Library and he loved it. And he decided that he wanted to learn from Ben Graham. So he applied to go to Columbia and he got accepted. And Ben Graham became his teacher and also his mentor and taught him a lot of what Warren Buffett knows and understands about investing today. So Buffett says, listen, it's a great book, but if you really have to focus on just the most important parts, you want to pay attention to chapter 8 and to chapter 20. And so what I've done is I've gone back and I've reread it and I've taken notes on those two chapters, and I just want to summarize them both for you so that you can have them in your mind and kind of have a framework that you use as you look at your own investing and just learn about investing before you even start. So the thing that I think you need to get in your mind here is that Ben Graham, he wrote this book in the 1940s and he survived this horrible stock market crash where a lot of people lost all their money in the stock market. It was like a mania. A lot of people who probably had no business investing took all their money and put it in the market thinking they'd get rich. And of course it didn't end nicely, ended horribly for a lot of people. It was a disaster. So one of the things that Ben Graham taught is the difference between investment and speculation. Put one way, investment, I'll just put it in Ben Graham's words from the beginning of the book. He said, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Okay? So that means it's business-like. You're looking carefully at what you're doing, you're learning about it. And then he says, operations not meeting these criteria are speculative. Okay? So he says anything that's not business-like, anything where you're not researching and learning and analyzing the situation, that's a speculation. And the definition of speculation is to make a risky trade in the hope of making a profit, to venture or gamble. So there you go. So he's trying to teach you to think about things in a kind of cool-headed way where you learn a lot and then you make decisions based on your understanding. So, in chapter 8, the title of chapter 8 is The Investor and Market Fluctuations. So he's talking about the psychology of the investor and how you look at the stock market, how you look at what's happening each day and how you either respond to it or not respond, which is another option for you. And the responses, usually when the stock market's going up a lot, people get very excited and euphoric and they want to participate. And then when the markets are crashing or declining, people get really pessimistic and they get very scared and they tend to want to sell their stocks. If they own any securities, they want to sell them because they're fearful that they'll just continue going down and down and down. So what Ben Graham proposed in this chapter 8 was this idea of a guy. It's a fictitious character, but he says, pretend that you're in business, you're a partner in a business with this guy, and his name is Mr. Market, okay? And Mr. Market has a very particular or very peculiar personality trait, which is this. You're both partners, you own like a piece of the same business. And on some days, he's like really excited. He is euphoric. He's so excited, and he wants to buy your part of the business from you. And he's just offering higher and higher amounts of money. And he's like, here, let me buy your share of the business. And then on some days, it's the other way around. He's really depressive. He's really unhappy. He's looking around him at the economy, and he's reading the news, and he just wants to sell you his part of the business, and he is willing to sell it to you at a really low price. And he said the interesting thing about this guy is that he has this other funny character trait, and that is if you accept his offer to sell him your share of the business or buy his share of the business, if you don't accept his offer, he's totally not bothered by it. He doesn't hold it against you. And the other thing is, he'll come back tomorrow and give you a fresh other option. He'll just say, hey, he's back, and he will either give you that wanting to buy your part of the business or wanting to sell you his. And so the lesson for all this for you, and this is the analogy he was showing you, is that the stock market's like that. Some days it's very euphoric and it's offering things at higher and higher prices, and some days it's really depressive and the prices are going down, down, down. And you can do something about it or you can ignore it, and that's your freedom. And it takes a certain psychological mindset not to be influenced by what the market's doing. And Warren Buffett has this great quote, I will never forget it. He said, the market is there to serve you, not to instruct you. Just let that sink in. It's there to serve you. If the price is one that works for you and you feel is an attractive price to buy into a security or to sell it, it's there to serve you. But it's not there to teach you. It's not there to instruct you. So don't think that just because the market's doing something, you need to act. Okay? So that's really the most important thing from chapter 8, the investor and market fluctuations. So now I'd like to move ahead to chapter 20, which is the other chapter that Buffett said was the best in the book. So chapter 20 is called Margin of Safety. And so what is a margin of safety? Well, Ben Graham, let me just grab the book here and read you the part right at the start of the chapter. Ben Graham said, confronted with the challenge to distill the secret of sound investment into 3 words, we venture the motto, margin of safety. And then he goes on to, spend the rest of the chapter talking about it. So he's distilled all of investing into those 3 words, okay? And so what is the margin of safety? Well, in my simplest way of explaining it to you, it's the price that you pay to buy something, and if you get it cheap enough, meaning you get enough of a discount when you buy, it makes up for kind of any mistakes you might make or any bad luck in assessing what something's really worth. Now, I know those are kind of vague terms, but they're going to have to serve until I get to a very specific example for you. And I'm just going to read here from the chapter. There was a really brief explanation for this. And this is from that chapter 20 on margin of safety. He said, we have to say that a true investment, there must be present a true margin of safety. And a true margin of safety is one that can be demonstrated by figures, by persuasive reasoning, and by reference to a body of actual experience. And, hold on, there's a little bit more. That actually wasn't the part that I really thought was the best part. Here we go. We have here, by definition, a favorable difference between price on one hand and the indicated or appraised value on the other. Okay, so you have the price that you're paying, and on the other hand, you have the value. That difference between the price you're paying and the value of what you're buying is the safety margin. It is available for absorbing the effect of miscalculations or worse than average luck. Okay, so, I know that it's hard to expand on that, but I think I'll leave it at that, okay? It's the difference between the price you're paying and the value of what you're buying, and you want that margin to be great so that if something bad happens in the economy or if something in the business is not as good as you thought it was, you still have a big margin between what you paid for something, which should be maybe down here, and what the value is. So you think you're getting a really good discount, and maybe you're off, but there's still a wide margin so that you're not losing money. The price is down here, it's very valuable. Maybe you were off, but you still have margin. So let me just use a couple examples from real life about a margin of safety. I just took a few notes before I made this video. Margin of safety in everyday life. Oh, and before I get into my own examples, I just want to mention one that I read from Warren Buffett, okay? Buffett said, "You have to have the knowledge to enable you to make a very good general estimate about the business." That's what Ben Graham meant about having a margin of safety. You do not cut it close. You do not try to buy a business worth $83 million for just $80 million. Okay? So don't make it close. That's too close. You leave yourself an enormous margin. And here's the analogy that he left. He said, when you build a bridge, you insist it can carry 30,000 pounds, but you only drive a 10,000-pound truck over it. And the same principle applies to investing. So if you're driving a truck over a bridge that built to hold 30,000 pounds, and your truck weighs 29,000 pounds, you just keep driving. You look for another bridge. Don't cut things close, okay? Another example might be, if you're going to the airport and you've got a flight and they say, be here at 2 o'clock in the afternoon for your flight, don't get there 10 minutes before the flight leaves and hope they're going to open the door for you, okay? Leave yourself an hour. Leave yourself 2 hours. Just leave yourself a broad margin of safety. If you're going and you're buying milk and you look at the top of the milk carton and it says this expires in, a few days, don't buy that milk. Buy milk that gives you 2 weeks until it expires. Give yourself that margin of safety. Another example might be your bank account, okay? You don't want to start, bouncing checks or getting fees, so keep a little extra money in there, a little margin, so that you don't cut it too close to the wire. So just thinking about that, giving yourself a little time, your homework is due tomorrow at 8 o'clock. Don't do it right before class, give yourself a little margin, do it a day early. These things aren't always the easiest, but with a little bit of practice, a little bit of organization, being business-like, you can lead your life in such a way that you don't cut things too close. So, there you have it. Those are the main two chapters. So, The Intelligent Investor, what can I say? When I first bought it, it seemed like a pretty dense book, a heavy read, and I didn't want to read it from cover to cover, but it's been a great asset, and I go back to it every couple of years. I'll pick it up and read through it, and it's nice knowing that there's somebody who existed a long time ago who really thought about these things and expressed them so clearly. And, even though it's now, 75, 80 years after he first wrote that book, it's still very true. So just keep those two chapters in mind, okay? And, don't give in to the market going up or down. Be clear in your thinking. Don't do things just because everybody else is doing them. And let the market be there to serve you, but not to instruct you. And also, whenever you invest, try to get a good margin of safety. So, I hope this has been useful and that you've learned something. If you have, please like the video, and you might even like to subscribe to this channel. And if there's anything you'd like to learn about investing that I didn't cover in this video, please put it down below in the comments. I will read them, and I will strongly consider making a video to help you out. I'm Jeffrey Luke, and thank you so much for watching this video.